What if the next decline in stocks is actually one of the best buying opportunities silver investors have seen in years? Today we're going to look at a macroeconomic signal that has historically created problems for equities. Inflation crossing above 4%. Fresh CPI data shows U.S. inflation has accelerated back above 4%, reaching 4.2%, the highest level since 2023. Historically, rising inflation tends to pressure corporate profits, increase interest rates, and reduce stock market valuations. But here's where things get interesting. For silver investors, a period of weak economic growth combined with persistent inflation, what economists call stagflation, has often created some of the strongest long-term bullish setups. In this video, we'll discuss why inflation above 4% matters, why stocks may struggle in the coming months, what stagflation actually means, why silver could benefit over the long run, and why lower silver prices today may be a gift for stackers using dollar-cost averaging. Let's dive in. On June 10, 2026, the latest Consumer Price Index report showed inflation rising to 4.2% year over year. That's significant because inflation had spent much of the previous few years moving closer to the Federal Reserve's 2% target. Instead, inflation is now re-accelerating. According to analysts, higher energy prices and ongoing supply chain disruptions are contributing to renewed price pressures. Energy costs rose more than 23% year over year. At the same time, real wages are falling again. Consumers face higher costs. Borrowing remains expensive, and economic growth is slowing. This combination creates a difficult environment for both households and corporations. Historically, stock markets perform best when inflation is stable or falling. Research examining market behaviors show that rising inflation tends to negatively impact equity returns with a lag. The market can ignore inflation for a while, but eventually it can't. Let's think about the chain reaction. First, inflation rises. Then the Federal Reserve becomes less willing to cut rates. Higher rates remain in place longer. Corporate borrowing costs stay elevated. Then, economic growth slows. This is where markets often begin repricing expectations. Historically, stocks have generally performed worse when inflation is accelerating than when inflation is falling. One analyst of the last 50 years found that the S&P 500's average returns were substantially stronger during periods of declining inflation compared to periods of rising inflation. Research also finds that inflation shocks tend to negatively impact overall S&P 500 returns, especially growth-oriented sectors. The exact statistic, often quoted online, that once CPI crosses 4%, the S&P averages negative returns over the next 3 and 6 months, but it's difficult to independently verify. However, the broader historical relationship is clear. Rising inflation generally creates headwinds for equities. And today's environment looks increasingly similar to periods where inflation remained stubbornly high while growth weakened. That's where the stagflation discussion begins. Stagflation is one of the most feared economic environments. It's defined as persistent inflation, weak economic growth, softening employment conditions, and normally inflation occurs because the economy is booming. Normally recessions cause inflation to fall. Stagflation is unusual because both happen simultaneously. Prices keep rising, growth slows, consumers get squeezed, and business struggles. Investors become frustrated, and today we're seeing several ingredients emerge. Inflation above 4%, declining real wages, higher energy costs, elevated interest rates, and slower economic momentum. So whether we officially enter stagflation remains to be seen, but the setup resembles the early stages of that environment more than the low inflation boom years investors enjoyed throughout much of the 2010s. And that's where silver becomes interesting. Silver is unique. It's a monetary metal and an industrial metal. During stagflationary periods, investors often begin searching for assets that can protect purchasing power. Historically, precious metals have attracted capital during periods of currency debasement, persistent inflation, financial uncertainty, and declining confidence in fiat money. Silver also benefits from a second force: industrial demand. Unlike gold, silver is heavily used in solar panels, electronics, electrical systems, AI infrastructure, data centers, and defense technologies. So while investors may buy silver for monetary reasons, industry continues consuming silver for practical reasons. And this creates a powerful long-term combination. If inflation remains elevated while governments continue running large deficits and central banks eventually respond with easier monetary policy, silver could find itself supported from both sides, the monetary side and the industrial side. So here's the part many stackers don't like to hear. If the economy weakens and markets sell off, silver may initially fall too. And that's happened before. In March 2020, silver plunged before eventually exploding higher. During the 2008 financial crisis, silver dropped sharply before beginning a historic bull market. The reason is simple. When liquidity disappears, investors sell almost everything. But for long-term stackers, lower prices can actually be beneficial. If your goal is accumulating ounces rather than celebrating today's spot price, temporary weakness allows you to buy more metal for the same amount of money. That's the power of dollar cost averaging. Instead of trying to predict exact bottoms, you should buy consistently, accumulate steadily, and focus on how many ounces you have. Because if the long-term thesis is correct, today's lower prices may look cheap years from now. The official CPI report may show inflation just above 4%, but shadow stats is much higher. So, whether you trust the government CPI number or shadow stats, the larger trend remains the same. The purchasing power of the dollar continues to erode over time, and that's the reality silver was designed for. For stackers, this is not a reason to panic. It's a reason to keep accumulating.